moment. So let's start with the truck market. That's the main concern point for DEF in North America, particularly Class 8 trucks, of course. So this is a chart of Canadian and US truck sales, and you can see that particularly in terms of a trend, you can see how buoyant the truck market's been recently. The last 4 or 5 years since the kind of financial crisis and the downturn in the early 2000s, we've seen steady growth all the way up to 2015. A particular kind of characteristic of this market, which you can see on this chart, is that pre-buy we had in 2006 ahead of the 2007 regulations. And if you're in the truck industry at that time, you'll remember the pre-buy only exacerbated really the financial crisis. So you had that early buying of trucks to avoid the 2007 regulations, which were particularly unpopular. The technology choice was an unpopular one there because SCR was avoided, so there was really difficult advanced EGR technologies that weren't very reliable, if you remember back then. And then we had the crisis, so you had that collapse of truck sales down to 2008. But as I say, we have had buoyant truck sales since, and 2015 represents the highest year in a fairly long period, almost 10-year period. So it did reflect kind of buoyant conditions in the truck industry. However, 2016 has been slower, and you can see there on the right-hand side, that's monthly sales by class, and you can see particularly the last few months, that's going up to September, the truck sales have been slower. The drivers of those are the basic truck industry dynamics, and if you follow these issues, you'll know truck loading has been down, average monthly truckload income is down as a trend from over the last 12 months, basically. ATA's data is showing that pretty clearly. Truck utilization is down, particularly Class 8s. So the future is looking a little bit more depressed than we have seen in the last few years, particularly 2015. So what does this mean for the future? We work mostly on our forecast with ACT, and many of you will know them. They track the underlying truck sales drivers in particular detail. And in terms of the outlook, we're looking at a slowdown in 2016 in truck sales. This is overall class 4 to 8 with class 8 at the bottom. And you can see there from 2015 of 493,000 units, 2016 is likely to be down to 460 roughly. And given the underlying demand for truck volumes and the trend of that going downwards, we're expecting 2017 to be a slower year as well. So we're expecting 2017 to be down to about 440,000 units, by which time there will be the age of the fleet and a pickup in demand is expected to start seeing an increase again. So by 2018, 19, 20, we expect to see a rise. Then you reach the 2021 time frame where we have the introduction of step 1 of greenhouse gas phase 2 regulations. And here it's an uncertain situation. We've only just had the phase 2 regulations published yesterday, in fact, in the Federal Register. So it's not clear quite how more expensive, the kind of technology that's going to be used on phase 2, step 1 by truck manufacturers. But if we make the reasonable assumption that that's a fairly stretching regulation, and therefore trucks are going to be more expensive and possibly more complicated, especially in the first step, it's reasonable to expect some kind of pre-buy. So under that assumption, this forecast, we're seeing an increase in truck sales to 2020, perhaps a drop-off in 2021 as customers adjust to those new technologies, and then perhaps a slow recovery after that. Of course, this is all subject to how things turn out for phase 2 in terms of technology choices. One thing that's really clear about that trend, if I go back a step, is the volatility or the variation is mostly on Class 8s. So the heavy-duty movers, the kind of full truckload, transport base load demand. Medium duty is less affected by this cycle. So if we focus on that particular segment, the Class 8 segment, you can see there more clearly that variation. As I mentioned, the average age of the fleet has been going down since 2014, which has pushed for sales, but that trend is changing, and that's going to be less of a driver for new sales in the future. Another interesting point about the truck market is that historically there's been a really strong correlation between GDP and truck sales, but that's decoupling in some ways, the digital economy and different ways of moving goods around. perhaps more use of rail. So that kind of direct connection is less obvious. So strong economic growth doesn't necessarily translate directly into the truck sales we'd expect to be seeing. And so we're not expecting that kind of buoyant truck growth that you might see if you were just to look at the GDP outlook for the overall economy. So this is what that truck sale forecast is translated into SCR fleet as a kind of basic driver for DEF consumption, and this is how the numbers look. So if you look at 2015, there were about 1.7 million trucks, power units on the road with using SCR. By 2.1, 2.2 million units, and of that 2.1, 2.2, about 1.2 are currently Class 8. So a big share of that are Class 8s. Of course, the biggest users of DEF, given the distances they travel and the size of those engines. Bear in mind the total Class 8s active on the road is around about 3.1, 3.2 million. So we're just over a third of the way through replacing all Class 8s with SCR technology. So it's going to take quite a while before that complete fleet replacement happens. I guess you'd say by 2020, 2022 timeframe, you're going to start seeing SCR trucks being replaced with SCR trucks. So that's when you start seeing the growth rate of the SCR fleets start to slow, because you're getting SCR trucks retiring, not just getting added to the population of vehicles. And so the growth rate kind of slows down on our projections using ACT data. It slows down from the kind of 16% growth rates until 2020 down to about 7 or 8% beyond that, as this phase in of SCR slows and the population matures to the point where it's mostly SCR. So by the mid-2020s, you'd expect most trucks on the road to be using SCR technology. So what does that mean for DEF demand? Key question, of course. So we track DEF demand really closely. It's important kind of metric for everyone to know where they stand in terms of current market volumes, current market shares. And we've been tracking this, as you be aware, for many years. This is the latest numbers. What we do with our calculations is as we get the monthly sales numbers for trucks, we put those into our calculation models and spreadsheets, and we update continuously on a monthly basis where we think that the current year will be. So just looking back, first of all, we think that volumes for DEF in North America for 2015 were about 490 million gallons. You can see there that's mostly commercial vehicle trucks, and of that green share, you're looking mostly about 80% would be Class 8s. Small shares there of off-road and light-duty passenger car. For 2016, based on that slowdown I mentioned in the truck sales, we're expecting the total volume to be about 620. That's kind of early estimates for the full year, and that's where we think things are heading at the moment. You can see there those sections of off-road and light-duty are relatively small compared to the rest. We've been doing quite a lot of work trying to tie down how the share of DEF is split between the segments. And one thing we're realizing is there's probably less DEF going into the off-highway applications than we had thought a year or two ago. By talking to suppliers, looking at the actual sales of equipment, which has been a bit slower than we expected, given the slowdown in the ag sector and construction. So in terms of the longer-term forecast, where do we see things going? Well, here's a projection of DEF consumption by that application type. And you can see there we're still considering total consumption for North America to reach about 1 billion gallons by 2019, just over 1 billion gallons in that time frame. And there's a few interesting patterns to observe in this kind of pattern, the structure of this forecast. The first one is clear, and that is we see that's the kind of slowdown of the growth of the commercial vehicle consumption. So continued pretty steep growth until about 2020, at which time those SCRs start getting replaced by SCRs, and we see a flattening out of that growth curve there. However, what changes in terms of the balance is we see an end to some of the flexibility which is built into the non-road application regulations. So there's averaging, banking and trading and other flexibility mechanisms that EPA allows non-road manufacturers to use in terms of their conformance to Tier 4 final. And especially with the off-highway equipment market being slower than it was expected to be, that flexibility is extended a bit further because, of course, if you've got credits and your sales are slow, you can, those credits last longer. So it's looking to us like for most manufacturers, some of those credits will last beyond 2017, even 2018. And so after that time frame, we then expect the consumption rates to really start increasing for that sector. And in the ag sector and in the construction sector, the treat rates or the burn rates of DEF are higher than the on-road sector, given many of those applications are already high horsepower engines running at high loads for like ag tractors running high loads for a big share of the time. So once those machines start using SCR more widely, you start seeing quite substantial growth, and that share grows quite quickly. 8 to 10% DEF consumption compared to fuel is typical for some of those applications. So it does become an interesting sector later on. Of course, passenger car and light duty is an interesting one. 12 months ago, we were here at the conference discussing the scandal at VW and what that means for DEF consumption and a kind of outlook for diesel. As it turns out, it's been a complete disaster for VW, as you're aware. I don't think VW Group has sold any diesels since. I don't think they're even allowed to yet, according to EPA's certifications. So VW, Audi, Porsche, those diesel vehicle sales have stopped just about completely. There are some passenger car sales using diesel still. BMW, I think, still carries on with a few thousand sales a year. There's a couple of other models. I think GM has one or two. But in terms of DEF, it's just about negligible. It doesn't even really move the dial at all. But what we do see is pretty good growth rates of sales of light duty. So pickup trucks and vans and other light duty vehicles using diesel, those are growing quite well. So the consumption of those vehicles is probably increasing faster than we expected. So overall, we do see a reasonable segment of consumption in light duty, but it's now more in terms of pickup trucks and light-duty vans rather than passenger cars. And I guess that segment's really focused on a different kind of product, many of them using 2.5-gallon jugs and other kinds of kind of packaged products rather than conventional bulk as we see on the heavy-duty. Finally, at this point, I would address the question of the longer-term DEF consumption on heavy-duty vehicles. So here's a really interesting question is, of course, if you follow the DEF market for trucks and you have customers that are using DEF, you'll be aware that as the years have gone by and the model years have been introduced, we've seen more DEF used per mile on heavy-duty trucks. As a result, first of all, of just the increasing sophistication of SCR technology. As engineers have worked out how to run those systems more efficiently and more effectively, they've been able to bank some of the fuel efficiency savings and translate those into lower fuel consumption. But offset by some higher DEF treat rates. And that's been pushed ahead, of course, by Phase 1 greenhouse gas. So we've got the 2014 target for Phase 1, which was met really comfortably by most manufacturers, even quite early on. Phase 2 has been a step two of Phase 1, which is 2017 model year, has been a bigger step. And if you're familiar with any customers using model year 2017 trucks, they've been on sale for a few months in some cases. We're already seeing higher consumption rates on those trucks. So sometimes 5 or 6% of fuel is being used on those trucks. Now you've got to bear in mind, we normally talk about DEF consumption as a percentage of fuel. If fuel consumption is coming down, of course, DEF might be staying the same and you'd have a higher fuel percent, DEF percent as compared to fuel. So in fact, consumption is increasing beyond that point. So what I'm saying is we're seeing DEF consumption actually increase on a per mile basis rather than just as a percent of the smaller fuel burn. So for example, we started with DEF consumption for trucks in 2010 at about 2.5%. Fuel consumption's dropped by perhaps 15%. So just that fuel drop would see an increase to 3% perhaps for a steady state on DEF consumption. But we're seeing much more than that. We're seeing more like 4 or 5%, even above 5% for model year 2017 trucks. So, PACCAR and Cummins particularly, I think, have seen increases already at that sort of level. So that's becoming quite an interesting amount of DEF consumption compared to the fuel. And it's certainly driving consumption quicker than just the pure truck sales would indicate. What happens next, though? Because we're at the 2017 model year now, which runs all the way to the start of Phase 2 in 2021. It's early to say what's going to happen in Phase 2 because the regulation has just been published. And if you were in the presentations yesterday, you would have seen that the variety of technologies being considered is really wide. there's probably 10 competing technologies for NOx control being considered. Some of them, of course, are mutually compatible, some are not, but those technologies are being quite carefully considered. The one thing that's trending out in the last few months in my discussions is that waste heat recovery is looking less likely, I think, than it used to look. So whereas some manufacturers were expecting waste heat recovery to be used from the beginning of phase 2, we're now hearing discussion about maybe waste heat recovering coming into the second or third step. It's certainly been incorporated into the EPA's stringency requirements. So in other words, when EPA configured phase 2, they assumed that waste heat recovery would be required. But EPA is technology neutral, and manufacturers are going to try and avoid waste heat recovery. It's an expensive system. So we might see that delayed until step 2 or step 3, which is 2024 or 2027. So what am I saying? I think we'll see probably the peak of DEF consumption in the period leading up to the start of phase 2 in 2021, perhaps even for step 1 of phase 2. But beyond that, we might get to the point where we reach the low NOx standard, and that's just been confirmed really recently. In fact, yesterday EPA, I think, probably said from a platform for the first time that they are seriously considering a new low NOx standard. It'll be too soon to get that in for 2021. I think most people are assuming 2024 for the low NOx standard. So bear in mind, phase 2 greenhouse gas has got nothing to do with pollutant emissions. It doesn't describe or define anything to do with NOx or PM. But a low NOx standard would be in parallel, which would be an EPA regulation. It would be a kind of 2010 follow-on, probably looking at 0.02 grams per brake horsepower, and that would have a very serious effect or impact on the technology choice, because it's difficult with current SCR technology to get down to 0.02. In fact, it's not currently possible to achieve that 0.02 using the configuration of just an engine with the SCR after treatment we have at the moment. So that's going to mean some engine measures, probably some EGR, more EGR, some other kind of things, perhaps NOx traps for cold starts, other technologies which could have an impact and probably would have an impact on DEF consumption. So what I mean is the kind of heavy lifting of the NOx removal is currently focused on the DEF, because it's the best way of optimizing engine emissions. So you can have a really efficient engine, high NOx out, 6 or 7 or 8 grams NOx out of the engine, and you use the SCR, which can run at 98, 99% efficiency to remove all that NOx down to 0.2. If we need to get another 90% down on that, 0.02, it's too much for the current systems. So if SCR doesn't make another kind of generation step in terms of improvements of efficiency, what we're going to have to see is some of that NOx removed in the engine. And that'll reduce the load on the SCR probably to some factor, perhaps half of the current load. So if I had to just look into a crystal ball right now, I would expect us to see DEF consumption running at perhaps 5 or 6 or higher % of fuel running up to 2021, perhaps beyond that. But then I think we may see DEF consumption drop from 2024 to back to 3 or 4% where we probably started in 2010. That's a complete guess. Things could change completely. SCR technology is developed almost beyond recognition in 5 years. So we could see a very simple architecture by 2024 where SCR is running at 99.5% efficiency with really hot, clean engines. But if that's not possible, then we would probably see a decline in DEF consumption. So I guess the good news is you've got several years of good DEF growth to come, and then we'll have a clearer view in 3 or 4 years' time once the engineers have done their work. How am I doing on time? Okay, so this is just a quick note on comparison with last year, because it's important to know what's changing. And I guess a key point to make was truck sales have been slower than we would have expected last year, so that's affected our kind of long-term forecast. Passenger cars, that's disappeared, I think probably for good for most cases. So diesel passenger cars are not going to be an important element of DEF consumption. And as I mentioned, non-road consumption is slower than we expected, partly because of the overall slowing in equipment sales linked to energy prices, slowdown in unconventional oil and gas construction sectors. So those are factors that have reduced our long-term forecast. So I think when you get to the 2025-26 timeframe, we're slightly lower than we were before, but in the short term, our projections are much the same because the short-term potential hasn't really shifted at all. Okay, I'm going to go faster through the next sections. Let's have a look at supply. I think there's, in terms of disruption or change to the DF business, probably more happening in supply than demand in the next year, certainly. This is a map of you'll have this on the slides to look at the detail, but you can see from the color coding what's going on. This is all the urea plants that are currently involved in DEF supply, both now and kind of in the short-term future. And you can see there the blue labels are representing plants that are currently active suppliers. We have the bright yellow dots are the plants that are currently being proposed and quite likely, but not completely firm. That would be North Dakota, up there in the North Dakotas, and we have the Mount Vernon plant, the Midwest plant. Those are both in advanced discussion kind of investment points, but not completely confirmed. Much further ahead, of course, are the new facilities being launched by OCI at Weaver Creek in Iowa. That facility is expected to be online by the end of the year. I'm not sure the exact date's yet clear, but that's a brand new giant urea plant that's going to have capacity for a pretty substantial amount of DEF. So that could be quite disruptive in terms of the Midwest region and how they decide to market that product. And then Coke is going to join the DEF industry. Not entirely sure when, but sometime in 2017 we'll see Coke start producing DEF at Enid in Oklahoma. So that's got a new entrance. And Coke, of course, a very powerful company. When they get involved in DEF, we'd expect some impact to the business. We have a change at Agrium. The project there is underway to reconfigure that, expand that plant. So we're going to, instead of getting just prills from Agrium, we're going to have urea liquid coming from there too. So that's going to be interesting. You can see the Borger plant there is well placed in terms of supply. It's the closest located to the kind of southwest region. So logistically well placed to increase supply from there through working with Old World. We should see some impact there. Question marks around some of the production plants at some of the existing facilities. So we do expect Donaldsonville CF Industries plants to get into DEF at some point. That's not exactly confirmed in terms of timing, but that's of course on the river. So in terms of logistics, we could see DEF or urea liquid moving up the river by barge or around the coast, as happens at the moment for other products from Donaldsonville. So there's a change in terms of supply chain coming. Geismar is another plant. PCS might get involved in DEF, as we could see from prior the LSB plants in Oklahoma. So this is a more variable picture than we've seen for some time. In the next 12 months, we do expect to see quite some change in terms of supply. How does that affect the industry? I do think it could. It could. Of course, increase the options for supply for key suppliers, for key buyers. So there's going to be an interesting interplay there in terms of the pricing situation and how that plays out. Because for the first 5 years of this industry, there were a selected number of urea plants involved in DEF. Basically, Dyno, CF, and PCS were the main ones. And so this changes the dynamic, and I think it's going to be really interesting to see how the scene pans out in terms of who they work with and what the pricing policy will be. The other thing that's changed since last year in terms of supply is the number of solutionizing facilities. So this is a map of all those facilities across the country. We now track over 80 facilities that can produce DEF either from prills or from concentrate. And also on this map we've laid out the Yara import terminals. I think there are 10 Yara liquid terminals around the coast, most of those moving to take more concentrated solution. So that coastal strategy is certainly getting rolled out more widely and having an impact in terms of supplying those regions. But more widely, we're seeing investments by all kinds of groups getting involved in. There should be a key on this. No. Getting involved. We're seeing some investment from truck stop groups who are looking to control their supply situation more closely, look after their own quality, and particularly in areas where they have concentration of truck stops looking after their own sourcing. So that's a trend that's probably going to continue. We have several really small players popping up, perhaps not with much experience, just trying to kind of mom and pop operations. Those happen periodically and sometimes succeed, sometimes don't. Of course, the network of the combined Victory Blue Old World group is an important one. That consolidation of those two companies has produced a very wide network of production based on solutionizing. Finally, just a note on pricing, because the urea price has been doing some interesting things, especially if you're a urea buyer. And this is the price trend for urea going back 5 or 6 years. You can see that we had that spike in urea prices in 2012, but in the last 2 years we've had a steady decline in urea prices, driven really by the global situation. This is not predominantly a North American situation. We have a global position on urea, which is a traded commodity, and China in particular has been oversupplied. There's been overinvestments in China, so that's weighed really heavily. Chinese exports of urea have been really high. The export window's ended, so that trade has weighed on the market. So prices have dropped quite substantially. We have seen an increase in urea prices just in the last few weeks, linked to some cutbacks in China, some major regions being overbooked in terms of their supply. This is a buying period ahead of the spring, ahead of the winter planting, so there's kind of some demand happening. But we don't expect this dynamic to change very much in terms of pricing. If you look at the investments in new capacities globally and also here in North America, the supply situation is pretty oversupplied, and that balance is not going to change for some years. So we expect this low level of urea price to continue. I know from our fertilizer team that track nitrogen prices in terms of the fertilizer impacts, we're expecting depressed urea prices for 2 or 3 years as the new capacity gets absorbed by the system and kind of gets incorporated. So we don't see a return to the 2012-13 urea prices for some time. We do a very simple analysis of margins in DEF. This is a really, as I say, it's just meant to indicate the trend of margins rather than the absolutes. So we track DEF prices. This is a trend of full truckload prices to end customers. So this is not wholesale pricing. This is large fleets taking delivery of a full tank load, for example. And what we've seen, if you look at this chart, in the last 5 or 6 quarters, we've seen a decline in that trend. So we're seeing a quite competitive pricing happening in the market on this basis. And we do see some this trend reflected across other modes as well. Pricing is becoming competitive. And the urea price has been dropping off as well. So the margins have been maintained, but we do see a squeeze in margins there. And I think we observe that this is a reflection of increasing competition in the market. More and more supply coming in. As I said, lots of those new solutionizing plants competing for business. And I think we'll continue to see that competitive environment reflected in the level of prices going forward. As I say, if urea prices continue being quite depressed, I think we'll see DEF prices staying at their current competitive level. But if urea prices do rebound, there's not a lot of margin left there, so I think we will see an impact on DEF. But on balance, I think we expect that to be quite unlikely. So that's the end of my presentation. Just to sum up, what do we have to say about DEF? I think you have to say the DEF market is in rude health. We are looking at a buoyant situation. Despite kind of competitive pressures coming, the growth is certainly strong. In the short term, technology trends are really pushing towards more DEF, especially on trucks, and longer term on non-road equipment. It's only going to be in 5 or 6 years' time before we might see some decline in DEF consumption for technical reasons as we start seeing those new low NOx standards getting phased in. So the market's there for the taking. We're only a third of the way through Class 8. It's pretty early on. Despite how kind of developed the market's become, there's a lot of opportunity still to be had. All kinds of structural changes coming, I think, from that supply change this year. So we watch closely to see what will happen with as those changes blend in and how the industry responds to what comes next.